folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory and thought we'd come to you today with a brief market update, kind of let you know what's going on in the world. I will just tell you it has been a week dominated by interest rates. S&P 500 hanging out right around 3,900. We've given a little bit back this week after we had a dose of interest rates and Fed speak. But we are still up about 8.5% since September 30th. So decent performance there. Let's dive right into it and talk about interest rates as well as inflation. We got the inflation report out on Tuesday, and that was very good news. In the core, we saw inflation slow down to 0.2% month on month. That is the second month in a row that we have seen a reading in that 0.3, 0.2 range. And so it's very encouraging in terms of seeing overall inflation come down in the core. You know, I will remind everyone that 2 months does not make a trend. The data is likely to come in and be very choppy over the course of the next several months. And the Fed, rightfully so, is looking at the long-term trend line, which is probably going to be 4, 5, 6, 7 months of lower than expected inflation prior to indicating that they might be looking for a pivot. You know, they're going to want to see that inflation has been under control for more than just 60 days before they indicate that they're going to be ready to take their foot off the brake. I will also just note that when we look at those types of price gains, we're obviously impatient. We see it happening, and we want it fixed now. And the reality is that we're only 60 days into seeing the inflation picture start to slow down. So, we really need to see more time before the Fed's going to give us a break on that. As it relates to the Fed, Mr. Powell came out yesterday and gave a very hawkish speech around, there's still a lot of work to be done to contain inflation. We're not ready to stop just yet. Dot plot was probably a little bit above where the street would like it to be for 2023 in terms of holding interest rates higher for longer. And I just want to explain what is going on here. The Fed controls short-term interest rates. So literally the Fed window, you come and you borrow overnight. Which is really only a relevant interest rate for very, very, very large banks that are looking to maintain reserves. So if you look at the actual interest rates impacting the economy, you probably want to look at the 5-year and the 10-year U.S. Treasury, because when most businesses borrow and when most consumers borrow, they are generally borrowing at 5 to 10-year rates. If you look at the 10-year Treasury, we peaked at about 4.5% a few months ago, and we are now down to about 3.5% on the Treasury as favorable inflation data has come through, which means that despite the fact that the Fed raised interest rates yesterday by 0.5%, the real economy has seen about a full 1 percentage point of interest rate loosening over the past few months, which makes the Fed's job very hard. As a result, I will just inform all of you that the Fed is going to continue to tell you very, very, very hawkish language until they're finished cutting interest rates. They are not going to telegraph the pivot. They are not going to tell you about it before it happens, because if they do, as soon as they tell you that the pivot is coming, then the pivot happens, because that's what happens to 5 and 10-year rates. If they get the sense that the Fed is going to be done 5 months from now, they will immediately collapse. So it's not that surprising, at least to me, to see the Fed come out and give these sort of very hawkish commentaries around, we haven't seen wages come down yet. We haven't seen unemployment go up enough. We haven't seen this, that, and the other. We're going to be, stuck with interest rates higher for a very long time, because if they told you anything else, they effectively ease. So just as an FYI, I would expect us to continue to see hawkish rhetoric out of the Fed. It's that time of year, switching gears a little bit. It's that time of year when we start to see market predictions for 2023 from all the major U.S. banks. You're seeing some crazy predictions out there. I saw one individual that predicted that the market was going to retest the lows, maybe even down to like 33 or 3,200 on the S&P before rebounding in the second half of the year up to 43 or 4,400. All of that to me me seems like the market telling you that they don't know. It is a very unpredictable year next year. If you average most of those predictions, you get to about a 10% return prediction for the S&P 500, which, as we've talked about before, is not that unusual. Most market analysts are kind of lazy, and the average return of the S&P 500 going back all the way to 1928 is 10%. And so most analysts, when they do this type of stuff, they just throw a 10% number out there and call it a day after they throw some very complicated research behind it. We just tell you that there's a lot of uncertainty out there regarding 2023, both to the upside and to the downside. Do we get a soft landing? Do we have a minor recession? What does that mean for the earnings picture? We just encourage people to continue to stay the course. With that, as always, if you have any questions for me, please reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you have a wonderful, wonderful, wonderful Christmas holiday.